According to research by Dalbar, the average American investor earned just 2.9% annually over the last 20 years, while the S&P 500 returned approximately 9.5% annually over the exact same period. That gap of approximately 6.6% per year is not explained by bad luck. It is not explained by poor investment choices. It is explained by one single thing: the way the human brain is physically structured to process financial decisions. According to Nobel Prize-winning behavioral economist Daniel Kahneman, the human brain makes financial decisions using two completely separate systems. System 1 is fast emotional and instinctive. System 2 is slow logical and analytical. When it comes to money, System 1 wins almost every single time, regardless of how intelligent the person is, regardless of how much financial knowledge they have. The emotional instinctive brain overrides the logical analytical brain at the exact moment that matters most financially. And the entire financial services industry spends approximately $700 billion every single year specifically designing products and experiences that trigger System 1 thinking in ordinary people. Because System 1 thinking makes ordinary people spend more, save less, and invest worse. Today we are going to show you exactly how that works, with real verified neuroscience and behavioral economics data, and exactly what any ordinary person can do to override the financial flaw built into every human brain. The single most powerful and most exploited financial flaw in the human brain is called loss aversion. It was discovered by Nobel Prize-winning psychologists Daniel Kahneman and Amos Tversky in 1979. Here is exactly what loss aversion means in practice. The pain of losing $100 is approximately twice as powerful psychologically as the pleasure of gaining $100. That is not a feeling. That is a measurable neurological reality. Brain imaging studies have shown that financial losses activate the same region of the brain as physical pain, the amygdala. The exact same neural pathway that processes the sensation of being physically hurt is activated when you lose money. Loss aversion is the primary reason that approximately 40% of American credit card holders make only the minimum payment every single month. Because paying off the full balance feels like losing money right now, even though carrying the balance costs approximately 21.5% interest annually. Loss aversion is the primary reason that ordinary investors sold their investments during the 2008 financial crisis and the 2020 COVID crash, locking in permanent losses at the exact bottom of the market. Because the pain of watching their portfolio fall further felt more powerful than the logical understanding that staying invested was the rational decision. Loss aversion is the primary reason that approximately 57% of Americans never negotiate their salary, even though failing to negotiate costs the average worker approximately $600,000 to $1 million over the course of their career. Loss aversion is not a character flaw. It is a neurological reality built into every human brain by approximately 200,000 years of evolutionary history. The second most powerful financial flaw in the human brain is called present bias. Present bias means that the human brain systematically overvalues rewards that are available right now compared to rewards that are available in the future, even when the future reward is dramatically larger. In a famous experiment by behavioral economist Richard Thaler, participants were asked to choose between receiving $15 right now or $20 in 1 month. The majority chose $15 right now, despite the fact that waiting just 1 month for $20 represents an annualized return of approximately 400%. No investment in the world consistently generates 400% annual returns. But the human brain consistently rejects that opportunity in favor of immediate gratification. Present bias is the primary reason that approximately 78% of Americans live paycheck to paycheck. Not because they do not earn enough money, but because their brain consistently assigns dramatically higher value to spending money right now than to investing it for a significantly larger future reward. According to research by the National Bureau of Economic Research, present bias costs the average ordinary person approximately $60,000 to $120,000 in lifetime wealth, simply through the consistent preference for immediate spending over future investment. The third financial flaw built into every human brain is called the anchoring effect. The anchoring effect means that the human brain gives disproportionate weight to the first piece of numerical information it encounters when making a financial decision. When a retailer displays a product with an original price of $200 crossed out and a sale price of $100, the human brain anchors to the $200 original price and perceives the $100 sale price as a bargain, even if the product was never actually sold for $200. Even if the product is only worth $50. According to research by behavioral economists Arlie Lowenstein and Prelec, arbitrary anchor numbers have a measurable and significant effect on the prices people are willing to pay for products, even when those people are explicitly told that the anchor number is completely random. The anchoring effect is the primary reason that credit card companies display minimum payment amounts prominently on every statement. Because anchoring ordinary people to the minimum payment amount makes them significantly more likely to pay only that amount, even though paying only the minimum costs them approximately $11,923 on a $5,000 balance over 22 years. According to research by the Journal of Consumer Research, the anchoring effect influences financial decisions in approximately 90% of ordinary people. The fourth financial flaw built into every human brain is called herd mentality. Herd mentality means that the human brain is neurologically wired to follow the behavior of the group, particularly in situations of uncertainty. Because for approximately 200,000 years of evolutionary history, following the group was the single most reliable survival strategy available to any individual human being. But in the context of modern financial markets, that same neurological wiring becomes one of the most financially destructive forces any ordinary investor ever faces. During the dot-com bubble of 1999 to 2000, ordinary investors poured approximately $100 billion into technology stocks at peak valuations. The Nasdaq subsequently fell by approximately 78%, wiping out approximately $5 trillion in market value. During the 2008 financial crisis, ordinary investors sold approximately $150 billion worth of stock mutual funds in the single worst quarter of the market decline. The S&P 500 subsequently rose by over 400% from that exact low point. The ordinary investors who sold at the bottom locked in permanent losses, while the investors who bought more during the panic multiplied their wealth several times over. According to research by Dalbar, the gap between what the average investor earns and what the market actually returns is explained almost entirely by herd mentality-driven buying at peaks and selling at bottoms, costing the average ordinary investor approximately 6.6% per year in lost returns, every single year, for their entire investing lifetime. Here is the data that connects every neurological flaw we have just described to the financial institutions that profit from them. The global financial services industry generates approximately $22.5 trillion in annual revenue, according to McKinsey Global Institute. Credit card companies profit from loss aversion, collecting approximately $243 billion in annual interest from ordinary Americans. Retail banks profit from present bias, while ordinary people's savings lose approximately 2.5 to 4.5% of their real value annually to inflation. Retailers profit from the anchoring effect, generating approximately $700 billion annually in sales that would not have occurred without anchor pricing strategies. And the investment industry profits from herd mentality, generating approximately $100 billion annually in trading fees from emotionally driven trading behavior. The financial system did not create these neurological flaws. They are built into every human brain by evolution. But the financial system has spent decades and hundreds of billions of dollars studying these flaws and designing every aspect of its products and marketing specifically to trigger them in ways that remain completely invisible to ordinary people. Here is what every ordinary person can do right now to override these 4 neurological flaws. To override loss aversion, set up automatic investment contributions that leave your account on payday before you ever see the money. Research by behavioral economist Shlomo Benartzi shows that automatic enrollment in investment plans increases participation rates from approximately 49% to approximately 86%. To override present bias, make a public commitment to your monthly investment amount. According to research by the American Economic Review, public commitment to financial goals increases follow-through rates by approximately 27%. To override the anchoring effect, always research actual market values before seeing a retailer's price. According to research by the Journal of Consumer Research, a 24-hour waiting period reduces anchor price influence by approximately 40%. To override herd mentality, write down your investment plan before markets move significantly. According to research by Vanguard, investors who had a written investment plan were approximately 40% less likely to make emotionally driven trading decisions during market downturns. Here is the single most important data point in this entire video. 6.6% per year. That is the gap between what the average ordinary investor earns and what the market actually returns according to Dalbar. That gap is not explained by bad luck. It is explained by 4 neurological flaws built into every human brain. Loss aversion that makes losses feel twice as painful as gains feel rewarding. Present bias that makes spending right now feel more valuable than investing for a larger future reward. The anchoring effect that makes the first number you see disproportionately influence every financial judgment you make. And herd mentality that makes you want to buy when everyone else is buying and sell when everyone else is selling. The financial flaw is not a personal failing. It is a neurological reality built into every human brain by 200,000 years of evolutionary history. The financial system did not create it, but it has spent decades perfecting the art of exploiting it. Now you know exactly what those flaws are, exactly how they work, exactly who profits from them, and exactly what you can do to override them. The financial flaw is built into every human brain, but now that you know it exists, it no longer has to control every financial decision you make.